Hello, and welcome to this webinar discussing the IFRS Interpretation Committee's recent agenda decision on overtime transfer of a constructed good. I'm Nicolette Lange.
And I'm Jawaid Dossani.
As you may already know, the committee works with the board in supporting the application of IFRS standards. When considering an application question, the committee may decide not to recommend standard setting because the standards already provide enough information for a company to determine its accounting. To explain why it did not recommend standard setting, the committee publishes an agenda decision, and often such agenda decisions explain how the standards apply to the question asked. The committee published the agenda decision on overtime transfer of a constructed good in March 2019. The agenda decision explains how a company applies IAS 23, which is the standard that applies to borrowing costs, in relation to the construction of a residential multi-unit real estate development. It also clarifies why, in the committee's view, the standard provides an adequate basis to determine whether to capitalize borrowing costs in a specific fact pattern discussed in the agenda decision. Respondents to the committee's tentative agenda decision raised some questions about the interaction of IFRS 15, the standard on revenue recognition, and IAS 23. In this webinar, we explain not only the conclusions reached by the committee on the question asked, but also the interaction between IFRS 15 and IAS 23 in the context of the agenda decision. We will begin with a high-level summary of the fact pattern and the committee's technical analysis and conclusions. In the fact pattern, a real estate developer constructs a residential multi-unit real estate development. Before construction begins, the developer enters into contracts with the customers for the sale of some of the units. We will refer to these units as sold units. The developer intends to enter into contracts for the remaining units as soon as it finds suitable customers. We will refer to these units as unsold units. One key aspect of the fact pattern is that the contracts with customers are such that the developer will recognize revenue over time applying IFRS 15. This means that the contracts for both the sold and the unsold units are such that the developer transfers control of each unit to the customer over time as it constructs the units. The question asked whether the developer capitalizes any borrowing costs it incurs while constructing the building. Jawaid, perhaps you can walk us through the requirements the committee considered when analyzing the question?
Absolutely, Nicolette. So the committee observed that applying IAS 23, a company capitalizes borrowing costs that are directly attributable to the construction of a qualifying asset as part of the cost of that asset. A qualifying asset is, by definition, an asset that necessarily takes a substantial period of time to get ready for its intended use or sale. So, the developer must first determine whether it has a qualifying asset before it can capitalize borrowing cost. The developer cannot capitalize borrowing cost if it does not have a qualifying asset. The first element of the definition of a qualifying asset is an asset. So in determining whether it has a qualifying asset, the developer must first determine which asset it recognizes. The developer then needs to assess whether those assets meet the definition of a qualifying asset. We refer to these two steps as step 1 and step 2 on the slide.
So if I understand correctly, the committee applied the thought process, being steps 1 and 2 from the slide, to both the sold and the unsold units to reach its conclusion?
Nicolette, your understanding is correct there. So for both the sold and the unsold units, the committee considered firstly which asset the developer would recognize, and secondly whether those assets would meet the definition of a qualifying asset.
Jawaid, let's first talk about the sold units. How did the committee apply the requirements to the sold units, and what was its conclusion?
So the committee observed that depending on the particular facts and circumstances, Applying IFRS 15, the developer might recognize either a receivable or a contract asset in respect of the sold units. The committee concluded that neither of those two assets meet the definition of a qualifying asset. And for that reason, the developer cannot capitalize borrowing costs in relation to the sold units.
We received some questions about why these two assets do not meet the definition of a qualifying asset. Why did the committee decide that these two assets are not qualifying assets?
So when you look at paragraph 7 of IAS 23, it specifies that financial assets are not qualifying assets. So the committee determined that any receivable that the developer recognizes would not be a qualifying asset. Now, if we move to contract assets, you will remember from the previous slide that IAS 23 defines a qualifying asset as an asset that necessarily takes a substantial period of time to get ready for its intended use or sale. The committee observed that the contract asset in this situation represents the developer's right to consideration that is conditioned on something other than the passage of time in exchange for transferring control of a unit to a customer. The intended use of that contract asset is to collect cash or another financial asset, and that is not a use for which it necessarily takes a substantial period of time to get ready. So, both the receivable and contract asset related to the sold units would not be qualifying assets.
In responding to the tentative agenda decision on this matter, some asked why the pattern of revenue recognition, namely point in time or over time, affects whether the developer capitalizes borrowing costs. If I understand this correctly, a developer might capitalize borrowing costs on units transferred to a customer at a point in time when construction is complete, but not when it transfers units over time as the unit is being constructed. What did the committee say about this?
That, Nicolette, is a very good question. Now, IFRS 15 specifies the accounting for a contract with a customer, and more specifically, the accounting for right and obligation that arise from the contract. To understand why the pattern of revenue recognition might affect the capitalization of borrowing cost, let's consider two different contracts with customers. They both involve the construction of real estate. The table on the slide summarizes the two contracts. In the first contract, which we refer to as contract point in time, the customer obtains control of the property only when construction is complete. In the second contract, which we refer to as contract over time, the customer obtains control of the property as the property is being constructed. Now, in contract point in time, the nature of the developer's promise to the customer is to transfer a fully constructed property. The developer will recognize revenue when it satisfies its performance obligation at the point in time at which the customer obtains control of the fully constructed property. Before this date, applying IAS 2, the standard on inventory, the developer recognizes work in progress inventory for the property under construction. In contrast, in contract over time, the nature of the developer's promise to the customer is to transfer the property as it is being constructed. So in other words, to provide construction services together with any embedded materials. Because the customer obtains control of the property as the property is being constructed, the developer satisfies its performance obligation and recognizes revenue over time as it constructs the property. The customer, and not the developer, controls the property as it is being constructed, and therefore the developer would not recognize work in progress inventory for that part constructed property. Instead, applying IFRS 15, it would recognize a receivable or a contract asset representing its right to consideration in exchange for transferring the part constructed property to the customer.
So, Jawaid, I now understand that in contract point in time, the developer's promise is to transfer a fully constructed property, and the developer retains control of the property, recognized as inventory, until construction is complete. So what does this mean in terms of accounting for borrowing costs?
In contract point in time, because the developer retains control of the property until construction is complete, it would generally be entitled to consideration only at that time. So, the developer may need to obtain financing for constructing the property during the construction period and may incur borrowing costs in doing so. For contract point in time, the developer may be able to capitalize borrowing cost because the developer has a work in progress inventory asset that might necessarily take a substantial period of time to get ready for its intended use or sale.
And for contract over time?
In contract over time, it is the customer that controls the property as it is being constructed. Now, if the customer were to pay for the property in a manner that is consistent with the transfer of control, the developer would not need to finance construction of the part constructed property and would not incur any borrowing cost on that construction. However, if the customer pays in arrears, so for example, if the customer pays only on completion of construction, the developer may need to borrow funds and may incur borrowing cost. In this situation, any borrowing costs incurred relate to financing the contract from the time of providing the service to the customer to the time of receiving payment for that service. That form of financing the contract is addressed in IFRS 15 within the requirements on a significant financing component.
Thank you, Jawaid. That's very helpful. Now let us talk about the unsold units that are under construction. Applying IS2, the developer might recognize inventory for those unsold units. Paragraph 7 of IS23 states that inventory may be a qualifying asset. In this fact pattern, would the developer be able to capitalize any borrowing costs incurred on the inventory relating to the unsold units?
Nicolette, you are correct in observing that the developer might recognize inventory for the unsold units being constructed, and if so, the developer would assess whether the inventory it recognizes meets the definition of a qualifying asset. In this fact pattern, the developer intends to enter into contracts with customers for the unsold units as soon as it finds suitable customers. When it signs a contract with a customer, it will de-recognize any inventory asset for the part constructed unit sold because it no longer controls the unit. It then recognizes a contract asset or receivable for consideration receivable from the customer. So, on signing a contract with a customer, the developer would no longer have any inventory relating to that unit. In other words, any inventory asset relating to the unsold units is already ready for its intended sale in its current conditions, and, in the words of IS23, would not necessarily take a substantial period of time to get ready for such sale. Therefore, in this fact pattern, the committee concluded that the inventory for unsold units under construction is also not a qualifying asset. Basically, in the fact pattern, any borrowing costs incurred in relation to these unsold units do not relate to constructing these units themselves. They are incurred to finance the developer's holding of the part constructed units during the time it takes the developer to find customers. This is similar to a situation in which an entity has completed constructing an asset and holds the asset while it tries to find a buyer for that asset. IS23 does not allow an entity to capitalize borrowing costs once an asset is ready for its intended use or sale.
Thanks, Jawaid. That brings us to the end of our discussion. We thank you for listening to our webinar and hope that it was helpful. If you would like further information about the committee, the standards, or the relevant agenda decision, please visit our website.